Hey, happy nearly, 2023? It's been a good year.
Yeah, another year almost done. We're just a few days away from the end of the year. What a remarkable year it's been, too.
Yeah, another one for the books. Today we have three topics to kind of look back on the year. They are rates, inflation, and stock market broadly.
Yeah, three things there's a lot of things that occurred this year, but three main items that we pulled out to kind of dig a little deeper and look at some charts and try to expand on these observations from the year and in some cases what it might mean going forward.
Yeah. Let's get into the first one of rates, specifically Fed funds and mortgage rates. What do we know about Fed funds rate?
Yeah, Fed funds rate, this is what the Federal Reserve controls. It's the short-term interest rate environment. We have, since the middle of this year, we've been at pretty much a 22-year high. The Federal Reserve was increasing interest rates for several quarters leading up to the middle of this year, and again, putting us at that high that we haven't seen for over 20 years.
Yeah, even in the past 2 years, we started at near zero for rates, and now we're at 5.5 or so.
Yeah, now we're over 5%. You're right, and from near zero, that's a big change in a short amount of time.
Yeah, let's look at mortgage rates, cost of a 30-year mortgage.
Yeah, equally as interest rates have risen, whether it's the Fed funds rates, mortgages have gone up too. The cost for a new mortgage, the interest rate has gone up. In fact, in some cases, it hit close to 8% for a 30-year mortgage. Right, that's a big change, again, from what we saw rewind a couple of years ago where we had rates that were closer to around 3% for a 30-year mortgage.
Right.
That combined with house prices that generally stayed pretty, prices that didn't really come down that much, kind of, in fact, went up in some cases. Right, it really led to housing affordability being at some of the lowest levels we've seen for a couple decades.
Let's get into inflation then, speaking of housing and assets and cost of goods and services. We've got another chart here for, what are we looking at? CPI inflation, Consumer Price Index.
Yeah, inflation's been a big topic over the last couple of years. Obviously, as inflation has accelerated, the money supply increased, really starting back in 2020, and that caused some effects of inflation. And if we were to look back over the last, call it 20 years, you would see that inflation in that time period, the cost of goods increased in that basket by about 66%. Again, from 20 years ago to today, with a lot of that increase occurring in the last 3 years or so.
I guess that takes us to the next topic of stocks.
Yeah, what we find is that although inflation has been present, that one way over time, we've seen this time and time again throughout history, is that one way to outpace inflation is to own assets that have the ability to do that, such as stocks. Stocks historically have done a good job of outpacing inflation over longer time periods. In this case, it's certainly also true. Equally, not just stocks, but assets broadly. It could be homes, as an example. And this chart where we're looking at that same level of inflation over the last 20 years increases 66%. But if we look at the total of all assets across the U.S., whether it's homes, financial assets like stocks and bonds, other tangible assets that people own, right? The rate of change or the increase in value of those far outpaced inflation over the last 20 years. In fact, it's up, 196% roughly in that time period versus inflation that was at 66%.
Let's look at breadth of the market. So we're talking about, we just looked at stocks and bonds kind of broadly. You're saying real estate in the mix too. Let's now focus just on the S&P 500. That's an index that's used to sort of track some of the 500 largest U.S. companies.
Yeah. Overall this year, we've seen really good performance out of the stock market, as we're mostly all aware. The market this year is up over 20%, and it's about 25% or so return for 2023 so far. That's a really good high result for the year, which is great to see. However, when we dig a little deeper to understand how did that result occur, we find that the market breadth has been relatively narrow. What we mean by that is there's been relatively few companies that have driven a lot of the performance of the overall index. Let's pick on the top 7. They're known as the Magnificent 7. These companies combined have generated about 80% return. Those 7 companies are up about 80% this year.
So if we look at the S&P broadly, we're up, like you said, 20 plus, 25%, something like that on the year. So that those 7 companies are pulling the weight of all the other 493.
Yeah. So the other 493, while they're positive, they're not up nearly as much. And you kind of start to extract the impact of those large ones, and you're only up about 10%.
We've talked about market breadth in the past as being an indicator of larger economic moves. Do you see that happening in this case?
Yeah, one observation was worth bringing up too is that although for the most part this year we've had narrow breadth, what we do find is that more recently we have seen it widen out, and that's been a good sign.
Do we want to hold after the highs? Maybe that's the big question.
Yeah, it is a question that comes up or something you might be thinking about. We are now back to pretty much all-time highs for the U.S. stock market. That was previously set early January of 2022. So here we are, late 23, and we're back to that all-time highs. We had a big hole, of course, in 2022 where the markets were down about 18%. We've dug our way back out of that, and now we're back to all-time highs.
You may have seen in the news, right? So Dow, NASDAQ, S&P, all of these indexes, are near or have made, highs, all-time highs.
Yeah, which is great to see as we've kind of dug out of that hole to have some recovery. But what it might lead to now is people thinking, what now? If markets are high, should I sell out of the market because it's high and it's probably going to go down again? We find that in the next 1 year after a market high, about 81% of the time the markets are positive again. Right? Momentum's a powerful part, and that certainly plays out in the stock market as well.
Is there still room for rebalancing or sort of getting that portfolio balanced just right?
Yeah, exactly. In fact, that's one of the things that we think is important now. Markets have moved a lot. This is a good time to rebalance, reevaluate, look at other asset classes that might be more attractive, perhaps. And so it's a great time to be looking through for rebalancing opportunities. That's a great way, in our view, to both preserve and help grow wealth over time.
Well, that's it for our three topics here. Certainly looking forward to 2024 and kind of bringing this perspective back throughout this next year.
Yeah, looking forward to it.
Yeah, thank you.